Hey guys, welcome to today's session. I'm just going to give people a moment to join and then we'll jump straight in. If somebody can confirm in the Discord whether you can see me, well, you won't be able to see me. If you can see my screen and hear me, that would be massively, massively appreciated. Just going to check that we're live on other platforms as well. The problem is today, well, over the past couple of days, there's been engineers out on my housing estate and they've been drilling random things and doing things, and they've affected the internet. So I just want to make sure that my connection's strong enough so that you guys can hear me, because all day my internet's been cutting out. So if we do cut out at any point, I'll try and get the stream back on as quickly as I can. But for now, it looks as though it's running pretty well as is, although it says that I have really low connection. So as I say, if we cut out, it's because of that, and I'll try and get the stream up and running as fast as I can, but I can't promise anything because if it cuts out and they've drilled through a line, I'm pretty stuck there. Anyway, guys, welcome to today's session. So this is a session where we kind of come together as a group and I go over different things that you can find on your Darwinex Era dashboard in relation to your trading. So we look at different metrics and statistics and variables that you might not have looked at before or analyzed to improve your trading strategy. All of the stuff that we go over is available to you on Darwinex Zero and Darwinex. So if you have an account with us, you have access to all of these statistics. Now, I am a trader and I've been a trader for the past 6.5 years. And before that, I was a data analyst. So this is kind of combined into my, I don't want to say passions, but work passions, if you will, and marrying them together to try and find an outcome, right? Which is always, how do I improve as a trader? How do I make more money as a trader? How do I mitigate my downside? So I'm a strong believer that a lot of traders would improve more if they took a look at different variables, right? So the most common variable that the average trader will look at to improve or look at to change if they ever need to is a technical chart, right? They will break down a pattern and they will say, well, this is my trading strategy based off of XYZ pattern. When I see XYZ, I'm going to do ABC, right? So it could be a level, support, resistance, a chart pattern, an indicator, whatever it may be. But usually 90% of the time, it comes down to a chart pattern or a technical indicator. Now, whilst that is fine to determine how you're going to execute and how you're going to manage your process on a day-to-day basis, you're ignoring so much information that you have at your fingertips, especially if you are a trader and you have data on yourself. Because a lot of these variables and these measurements that we look at will tell you a lot more about your trading strategy than a chart would anyway. So with that being said, what I usually do is I usually ask guys or girls who are in these sessions to provide me with their Darwin if you want your Darwin to be analyzed, and I can load it up and we can use your Darwin as kind of the what would you call it, the example for the session, right, where we can take a look at your metrics and I can provide real-time feedback and we can take a look at some of the things that you do well or some of the things that you don't do so well. When I'm doing this, I usually ask for at least 6 months worth of track record, because doing it too early, you can kind of make irresponsible decisions in terms of changing things too early, identifying patterns that would really be an anomaly in a larger set of data. But when it's such a condensed, diluted set of data, let's say you've done a month or two worth of trading, we don't really understand how that behavior would be replicated over an extended period of time, i.e. when interest rates are different, when there's a different president, when there's, whatever it may be, risk on, risk off environment. So what's really good is, the longer the track record, because we can say with more justification, you need to be putting emphasis on this area or looking how to improve XYZ, because over different market regimes, through different market cycles, we're seeing the same repetitive behavior. For example, what I mean by this is if a trader has a really, really poor maximum favorable excursion, okay, or a really Yeah, let's stick with that. They have a really poor maximum favorable excursion because the market's been ranging for the past couple of years for whatever it may be. As soon as the market regime changes, that trader is still stuck using those. They might look at that past 6 months worth of data and go, well, on average, my winners, they run 30 pips or 40 pips for me. So that's where I'm going to adjust my target to be at 30 pips. Then as soon as the market, goes into a trending regime or a trending environment, the trader's still capped using a 30, 40 pip target when really they should be capturing 100, 200, 300 pip targets. Very broad example, but all I'm trying to drill down here is the fact that markets change and you have to adapt. But to know how to adapt and to know how to stay consistent through the different regimes, you need a big data set. Okay, so I'm going to stop rambling here. I'm going to ask if there's anybody in the audience, whether you're on Discord, YouTube, Instagram, X, whatever platform that you're watching from. If you want me to take a look at your Darwin, please just pop it in the chat on whatever platform that you're watching this on, and I'll load it up and we'll get started. Usually I only stick with one per session because it takes us a full hour to go through pretty much every metric that we have on the platform. Sometimes it takes us a little bit less, sometimes it takes us a little bit longer. I just realized, just looking at one of my charts, that the volatility's picked up this afternoon. Interesting. Okay, I can see people are being quiet today. I don't know if there's something in the water, if everybody's half asleep or what have you, but if nobody wants to have their Darwin analyzed, which is absolutely fine, by the way. Okay, so Breezer said, I don't have any account. You need an account, right? I'm new here. Well, it's a pleasure to have you, and thank you for joining the session. Of course, if you're new to Darwinex, then you'll be new to this session, but this is something that we do week in, week out, where we go over the metrics that we provide to our traders so that you can understand, without my guidance or without help from us at the community, what you can do on your own to look at improving your strategy on a day-to-day basis. Now, the Darwin, or the account that's loaded now, is one of mine. This has only been live a week. I'm constantly building new Darwins. I'm constantly building new strategies out. So we can use this, but it doesn't have a lot of data. Breezer said, do we need to deposit money to trade, or can we prove our skills without investment? Okay, fantastic question. So we have Darwinex and we have Darwinex Zero. So Darwinex is our FCA regulated broker. If you want to trade through Darwinex and through our broker, then yes, you would have to deposit a capital, which would be a minimum of $1,000. You can get access to all the infrastructure that we have, whether it's our strategy insights, our metrics and analysis, like what we're going to go over today, our DarwinIA allocations, invest capital, the list goes on. If you want to do it without risking your own capital, then we have Darwinex Zero, which is the interface that you're looking at now. Now, that doesn't have any risk to your capital because it's a virtual environment. However, there is a subscription fee. So Darwinex is free, but you're obviously going to be paying in broker commissions. Darwinex Zero isn't free, but it's €38 a month. You get access to everything, again, the same as you would with Darwinex. It's completely live conditions, although it's virtual capital, but you get to prove you can trade without having to risk your own capital. I saw a different drawdown for different people. Well, yeah, because people have different track records, unless that's not what you mean. I'm also going to stand up because I've been sitting down all day and I'm starting to get a little bit crampy, so. Do I need to pay a monthly subscription? Is it enough? Yeah, so to trade with Darwinex Zero, you would have to pay a monthly subscription. The alternative is, like I say, opening a live account with Darwinex, FCA regulated broker. But of course, that is completely down to you. There's no preference from us. We don't treat clients differently depending on whether you're trading a live account or trading through Darwinex Zero. To us, we give you the same infrastructure and you can achieve the exact same things. Anyway, let's take a look at some of the metrics. So, because there's nobody here who wants their Darwin analyzed, which is fine. There's some guys in the audience who've already had theirs analyzed, and I'm also aware that not everybody wants their Darwin or their track record public, which is absolutely fine. So we'll take a look at one of my accounts. In fact, I just don't have enough data. That's the problem. No, we'll do it. We'll do it. The great thing about this account is, and it might actually be really helpful, to be fair. I know Snowy will probably find this breakdown interesting. It trades very, very frequently, so it's an active account. So we do have a lot of trading data, albeit, you know, or a lot of trades, sorry, even though the record isn't long. But this is something that I've been looking at doing for quite some time. So I am a discretionary trader, but I also build automated systems on the side. I have a portfolio. So my main portfolio is XAQP. Bookmark it if you want. Whether it sustains and grows, I don't know. That's how I built it, so I'm hoping it will. But this is one of my portfolios. So this currently has roughly 20 strategies running. Now scalping tops the chart. This is about 20 automated strategies all running together. They are uncorrelated. There's breakout systems, mean reversion systems, and trend following systems. This is kind of my main account. But when I was building this, I had an idea. And if you're new to Darwinex and you don't know this, we employ a proprietary risk engine that monitors our traders' exposures 24/7. Okay, so the risk engine will watch your exposure and it will cap it. It will reduce your exposure or increase your exposure depending on how much risk you take. Now, I've been working at Darwinex for 2 years. I know the product inside out, and I started to wonder, is there a way to not game the system, not game the VAR or the exposure, but to hedge against yourself in some form of weird way, right? So if you're familiar with the risk engine, you'll know that it's not a fan of martingale or grid strategies, period. And the reason for that is martingale and grid strategies, as they go into drawdown, they tend to add exposure and they build exposure up over time, right? So the downside is very, very, it's like a slippery slope, okay? And there's no kind of limit to how bad things can get, whereas the upside is very, very stable. Now, I was thinking, is there a way to, and what it will do, what the risk engine will do is it will start intervening. So as you're adding exposure, the risk engine will stop adding exposure and start removing it. And therefore, it may close your trade in a loss at Darwin level, even though your signal account is still in profit because it's reduced exposure through the period of the trade. Now, I was thinking, I wonder if there's a way to counteract that to a degree. And so what I put together here, which is working really well, it's still too early to tell whether it's going to work long term, is to have a martingale running really well. It's more of a grid than it is a martingale. Have a grid system running at really low risk. So I currently have 10. Is it 10? It might be 8. I think I have 8 grid strategies running on this portfolio, which is my second portfolio, running at a really, really, really low risk level. Those are then balanced by a couple of breakout strategies that I have running at a much higher risk level. So not a high risk level, they are still really low, but they're much higher than the risk that I run the grid systems on. Now, the reason I've done that is because the last time I ran a grid system on Darwinex, I ran it really low risk, but what it did is it ramped because my value at risk was so low, it ramped my risk multiplier up to like 40 times. So when I went into 1% drawdown on my signal account, my Darwin went into like 40% drawdown or something ridiculous. And I thought that's the issue that I can't have because the grid will be super stable over a period of time. I cap the max loss of a trade, which I've never experienced over all my tests, all of my live trading, with the way that I run it so low risk as a portfolio and different assets. I've never experienced a really, really bad drawdown. Of course, I know they can happen, but the measures that I put in place mitigate that. Okay, so if the account goes into 2% drawdown at signal account level, that's where I clear the grids and I go, okay, no more trading. We'll clear that. We'll take the hit and we'll rebuild it back. Okay, so that's kind of a fail safe to just in case the grid fails. However, because we have the higher risk trades coming in from the breakout strategies, what that stops is it stops the risk multiplier from, going above the ceiling. So because my value at risk is so low, and I think on this account it's about 2%. If I load that up now. So it's 1.92 at the moment. The breakout strategies, what I've noticed, are counteracting the instability of a grid system value at risk. So if you've looked at a martingale strategy before or a grid system, the value at risk is usually pretty, I don't know, it can't really figure it out. But because we're looking at my worst trades, which are the breakout trades in terms of exposure or risk, it's balancing it based off of that. Then the martingale trades or the grid trades are all underneath the value at risk of the breakout trades at a very, very granular level. So what I've noticed is if you look at this value at risk line, it's super linear. That even though there's different positions, even though there's different strategies, all running at different risk levels, the value at risk line is super consistent. And what I found is because I have the imbalance in risk per strategy, what it's doing is it's actually taking a look at my value at risk using the breakout systems as going, well, this is the highest amount of exposure that we take, so we're going to scale the trade up from there, even though it's at low risk, but it's higher than the grid risk. So we're going to scale them up from that point of view. So my martingale trades or my grid trades aren't getting blown up massively by like 40 times like they have been in the past. So I hope that provides a little bit of context to this account and why it is what it is. But I think that's important because I'm never an advocate for grid or martingales. I do them personally myself on some account, not on all of them. So XAQP, for example, doesn't have a single grid or martingale on there. However, my BYXB does. But like I say, I manage them, I control them, I will exit trades if something goes completely wrong. And that's what a lot of people don't do when they have a martingale strategy. So there's a couple of questions in the chat. I'm going to take a moment to answer those now, and then we'll jump into some of the statistics. So Breezer said asset management means is investor money. Yep. So we have DarwinIA capital allocations, which is virtual capital, which we provide to our traders on a monthly basis. We also have permanent allocations, which is a €100,000 allocation that you can purchase that never leaves your account. So it will be there forever. And then we have investor capital. And then Darwinex has our own hedge fund, which is called the index or the INDX. And that is also real capital that goes into our traders. So yeah, it's a hybrid of both. But we have over $100 million of investor capital on our platform allocated to traders. Malcolm said, I have a question. What if there's somebody interested in investing in you? Can they use the Darwinex Zero platform to select your strategy and allocate money to it? If you are in DarwinIA Gold, then absolutely they can. If you're not in DarwinIA Gold, then you're not open to investors. If you go into gold and then fall back into silver, your Darwin will still be open to investors. OI Elamari said, is future account good for scalping or not? I mean, I don't scalp, and I also don't trade futures at Darwinex. I do trade futures elsewhere, but I don't trade futures through Darwinex, so I can't answer that for you. I would say, and rather than me sitting here and giving you a biased approach as to why it's good, I would rather you get feedback from somebody who trades futures and who scalps, so that you actually get an unbiased opinion. Breezer said, the higher your rank is, the more investors will attract and you can get good capital. Is it right? So yeah, in a way, of course, the higher that you rank in our leaderboard, of course, the more exposure that you're going to get, but it's going to take time. You won't get access to investors for at least 8 months through Darwinex Zero because you have to hit DarwinIA Gold. And the minimum requirement is 8-month track record, 20% return, and a minimum drawdown to return ratio of 2.5. Snowy said, I saw some good results from scalping futures, but they're using their own strategy. You have to find your own. Yeah, of course. If I'm in future traders, there's no in between. They're either awful or they're really good. Anyway, let's take a look at some of the metrics. So on the return to risk tab, you have your equity chart. Now, this shows your risk-adjusted returns, of course. We never show your Signal account statistics, which is your MetaTrader statistics. So you can see, for example, this account, it's only been live for a couple of weeks. I started at the very end of June. I think the first trade, if I check the history, let me pull it across so you can see all history. So the first trade was on the 23rd of June. So it was literally half a month ago. Well, it's almost a month ago. The account is up $800 at Signal account level, and the account is up 2.41% at Darwin level. That's interesting. I don't know why there's discrepancy between my quote and my return. I don't think that's updated properly. Let's take a look. There we go. It hadn't updated. I was over 3 just and over 3% return, but I just got stopped out on a gold trade for some reason, and it's carried on. So it is what it is. But that was actually a gold breakout trade, got stopped out, but at least we're hedging against it with the grids. So, in fact, how much am I down today? Let's take a look. Custom period today. Down 174 at signal account level, but barely that at Darwin level, which is interesting. But again, because Darwin caps the exposure to grids, my grid trades were kind of in a little bit of drawdown today, but Darwin's capped it, so the downside's actually not been too bad. But anyway, we get access to the risk-adjusted chart. You can see DarwinIA allocation and investor capital down here. Again, I don't like the fact that it shows a return for June, considering I traded like 3 or 4 days in June. But we got a positive July. Again, it's not a track record we can really analyze and take much from, but there is a decent amount of trades, so I'm still happy to do that. And because it's my strategy, I know exactly how it's trading, so I know how to relate what I'm talking about into, you know, strategy specific things. We also give you a few different metrics. These are kind of your basic metrics, your Sortinos, your sharps, your skewness, kurtosis, all those sorts of things. I feel like there's something, it could be my internet right now, right? But that didn't update, and some of these metrics aren't showing, so I think it's probably my internet. So I apologize, but these should be populated. They have been in the past, so I'm not sure why they are now. And we have a few different metrics down here. So we have like your return distribution. So this shows you each day, or how many days you have a return between X% and Y%. I don't really look at this too much. I don't get too bogged down in this kind of thing because I don't think it really serves you too much. Although the drawdown analysis is quite interesting. This shows your biggest periods of drawdown. And the reason this is important is the longer your track record goes, when you're feeling a little bit down about your performance, or you're thinking you're in a bit of a rut, take a look at your previous drawdowns and look at how long those periods lasted. It can also give you a bit of a gauge as to where you are right now. For example, if you've been in drawdown for the past month, and you're slowly climbing out of it and you're feeling a little bit deflated and disheartened, go and look at your previous drawdowns, because if they were over a month, there's nothing really to worry about. You know, if your worst drawdown was 6 months and you're only a month in, things could get a lot worse because you might have another 5 months, right, of drawdown, because that's what's happened in the past. But also there's no need to feel that bad because you're only a month in and before you sat through 6 months worth of drawdown. So it's good to know where you are now relative to what you've experienced in the past. You can kind of get that from backtest, but usually when people backtest, they don't look at this sort of thing, like what was my biggest drawdown period or the biggest period of stagnation. But it's really important to remain sane, right? Your equity curve isn't always going to look like this. It's not always going to look up only. There is going to be periods of time where there's stagnation, and it could be days, weeks, months, even years. And you just have to trade through those periods and, keep level-headed. Next, we break down your assets and timeframes. Oh, there we go. Ooh. Sorry, I just had an alert ping off. Also, because I'm not analyzing one of your guys' Darwins, I'll take this session a little bit lighter. Usually I'm metric. I'm currently in this Dow trade. I'm not in any of the others. I'd cancelled my orders earlier after it rejected before my level, but I'm currently in this Dow trade on pretty much all of my accounts, actually. So I just want to check them, see how they're moving on. XAQP just took a winner, which is nice because it took 2 losers today. So I think it's up like $50 for the day. And then a couple of my other accounts are in that trade as well. So that's really, really nice. I'll probably consider moving my stop later on today. I tend to trade with quite a wide stop anyway, at least when I'm trading discretionary. But enough about that. So on this trade, or on this account, sorry, the majority of my trades come from FX CFDs, which it doesn't surprise me because the majority of the grid strategies that I run are all on FX. I also run it on gold and have a breakout strategy on gold that hedges the grid strategy. And so you can see commodities, a pretty decent chunk with relatively nothing happening on indices. I think I tested a couple of trades out. I do have one running on the Dow, but I haven't fully optimized it yet. So whether or not I continue to use that, I don't know. The great thing with this, and you can split it by assets so you can see exactly which assets you're most profitable on, etc. The great thing with this is you can kind of look for dead weight and then cut it early, okay? So right now, I don't have enough data over a extended period of time to be able to make these kinds of decisions to say, I shouldn't be trading this because I'm not profitable on X, Y, Z. However, if you've got a year's worth of data and you check the assets that you trade, you might find that you're kind of a jack of all trades and a master of none. You might find, and I see this on a regular basis, bearing in mind that I study hundreds of Darwins a week, so I'm constantly looking at these things. You will sometimes have a trader who excels on gold, for example. They might have an 80% strike rate and 90% of their return might come from trading gold. But then they're trading 40 other assets and they're break even, negative, slightly positive, maybe positive on another one or two. And I look at that and I'm going, you're taking all this exposure to kind of not really take any step further. Okay. And I get it if you're trading other assets to hedge against your main strategy. So for example, in that example, if that trader is primarily a gold trader, but then they hedge themselves with FX pairs, maybe they have a few different strategies that hedge their main system so that when their main system underperforms, the other systems kind of make up the weight for that. And that's totally fine. However, if you're not doing that, if you're just trying to, again, going back to the start of the session where I spoke about a trader who has one common denominator on all of their positions, which tends to be a technical chart pattern. If you're the kind of trader who's going, I see ABC and I do XYZ and I'm going to do it on, 40 different assets, those assets are all going to perform differently and you have to know how each asset differentiates from one another. Okay. And if you take a look at your statistics and you can see that on euro dollar and pound dollar and dollar Swiss, you're way outperforming. Okay, cool. You've got your niche. But then if you see a dollar CAD, dollar yen, euro Swissy, for example, all of these, you're way underperforming and you're just consistently hemorrhaging money and you're just losing constantly over time. Maybe it's time to cut out those assets, save that risk exposure and allocate it back out to the assets where you can actually perform well over a period of time. So I like to look at this to be a little bit more granular. With the grid strategy, I'm constantly looking at this because I want to know which systems have the lowest risk to run those strategies on and still pay off over time. So you can see I do have a good win rate. That comes with having kind of a grid system anyway. Gold I'm surprised about because, like I say, I've got the breakout strategy there. But dollar CAD's an interesting one. A really high win rate, but again, it is a grid strategy, so I don't read too much into that. But these are all variables where I'm looking to find the highest expected value on every position that I get into. The trades with the highest expected value are the ones that I let run, the ones that I put my foot down on the gas with, and the ones that I will push size. Whereas if I know that I've got less of an expected value or a lower expected value, I'm more happy to pass up on that opportunity and just not get involved. Trading time distribution. This is where we take a look at your trade split by which session you're active in. So of course we have the London session, American session, and the Asian session, or the European session, sorry. Majority of my return comes within the European session. Not too concerned about this, again, one, due to lack of data, and two, because it is automated. So I'm not really too bothered at this point. Maybe in the future, I will block out certain times of day for the EAs to trade, but as of right now, I'm not bothered about that. Again, this is quite an important one for discretionary traders, where some people really struggle to put the mouse down for the day and to walk away from their desk. If you can see categorically you don't perform well in the US session, maybe your setup or your strategy just doesn't perform well during that time or period of day. Why continue to trade it and continue to put yourself through exposure with no reward? It doesn't make sense. So maybe it turns out that you should probably take a step back during that period of time. Maybe you finish at 11 a.m. or 12 p.m. or 2 p.m., who knows what time it is, but just put your foot down on the gas where you know your system has the highest edge, right, or the highest expected value. My favorite statistic is your return distribution by day of the week. Now, this is very similar to the sessions. We measure your return, but we split it based on the day of the week, okay? And we look at which days are most profitable and which days are least profitable. I really like this statistic, but there are certain nuances to it. Okay, so for example, if you hold trades over the weekend, maybe your Mondays are going to look good or bad depending on whether those trades lose. However, what you tend to find is that most traders have a fantastic day, have a really poor day, and then have three sort of days. Okay, now you can see the patterns kind of taking shape, but again, there's like 3 and 4 weeks, so it's just way too early to tell. But the charts usually look something like this, where you'll have one day that way outperforms all the others, you'll have one day that might be negative or low in the positives, and then you have 3 really close days like this, where it kind of feels like the majority of your return comes from the one day. The other 3 days are just kind of like they do nothing for you really as a trader, and then the other day is the one that you have to contend with. The great thing with this is knowing based on those days is that you can set up your routine for that. If you have a day where you know over the past X amount of years that you historically underperform, well, okay, pull back on that day. It doesn't make sense to, if you're still going to trade, lower your risk slightly, or only take the A-star setups or whatever you want to call them. Take that step back. Oh God, the market's still going. I've just been triggered into another trade, and I don't think that's going to work. Oh well, it is what it is. It's automated for a reason, right? Oh no, it's gone. Stopped out straight away. Jeez Louise. What's even happened this afternoon? I don't even know. Has there been news? High volatility now with CAD. Yeah, it was a breakout trade on gold on XAQP, but it just got applied, got triggered and then stopped out pretty much instantly. Today, apply. Let's go high. I mean, there's nothing really. I can't be bothered to go on Twitter and find out why this is happening, but it is what it is. We'll try and ride that Dow Jones trade down. See if that can pay off. But yeah, I'm just look at the size of some of these candles. Like out of nowhere, like, yeah, strange one. Oh well. Okay, so moving on. Let's take a look at the strategy analysis tab. So again, we give you some statistics about your system. So this strategy, this is BYXB. It's taken 592 trades. So again, in less than a month, it's extremely active, which is why I don't mind going over it for the purpose of this session. Even though it doesn't have a long period of time, a long track record. It has a 36% long exposure, which is interesting to me. Usually with the sort of strategies that I'm running, it's more 50-50, but that's interesting. I just think it's a lack of data that will probably balance out. How are we doing, J-Sync? Hope you're good. 76.86% win rate overall. Again, using grid, you're always going to have a high win rate. We give you the profit factor, so 1.55. As long as you're sat up of 1.55, I think you're pretty safe. 1.5 is kind of the benchmark minimum. I personally like to have a minimum a minimum Sharpe of 1 or 1.5 and a minimum profit factor of 1.5. If you can get the Sharpe to 2, fantastic. But I don't want to overfit systems just to sort of suit those statistics. Average winning trade is 0.02. Average losing trade is 0.04. Give me a negative payoff ratio. Of course, that is what happens with grid systems. Again, I've explained a lot of the strategies that are running on this portfolio so you understand. It's hard to combat that unless I start putting more breakout strategies and trying to hedge out that grid a little bit more, which I will do over time. But right now, this doesn't concern me too much. Again, negative duration ratio. So this just measures your average losing trade and average winning trade duration. But again, with the type of strategies that I'm running, it's going to be very, very difficult to turn that around. Duration versus profit trade. Buy trade, sorry. This is an interesting one. And this basically shows you how many trades, I can't even get my words out. This shows you how many pips you win or lose based on how long you're in the market on average, okay? So if we look at each square, you can see this square down here. So this shows any trades that fit the following category. Less than 30 minutes, and take or return of 0 to 10 pips. And you can see that there's 263 trades in that square. So we have a category of trades there based on how long you're in the trade and how much you take from the trade. Now, what you can do with this, again, going back to expected value, is to figure out at what point does my expected value start to wear off? Do I have a hot zone where I generally win the majority of my positions? Do I have a danger zone where I generally lose all of my positions? So what you tend to find is swing traders, they have a bit of a danger zone for the first 30 minutes or first hour, which is the first two squares, because they generally need their trades to play out, right? On the flip side to that, you'll find that a scalper, they generally have a bit of a hot zone in that point because they want to be in and out. They want to take small wins and small losses. So you'll find the majority of their trades are clustered there, and that's probably where they have the highest expected value. If you're a scalper, it doesn't make sense to be holding random trades for 14 hours. So what you'll probably notice is the efficacy of their strategy deteriorates as you go up the chart, which is the trade duration. So you'll probably find the higher you go up, the more skewed to the red side, which is losing trades, the more skewed to the red side you'll probably end up being. Then we have max positive, negative excursion per position. This is by far my favorite metric to trade, and it has been for years, even before I started working with Darwinex. However, the problem is the way I run these accounts, being a portfolio of different strategies, is you can't really take much from this because the big winners that you see are all the breakout strategies, okay? The tiny trades are all the grid strategies. And again, going back to my point about the value at risk at the beginning, where I'm hedging kind of the value at risk more so than anything, is you can see my winners or my big winners are still bigger than my big losers, right? Which is interesting because that's probably why my VAR is so stable, because it's taking my biggest winners, my biggest losers, and kind of measuring my exposure or the stability of my exposure based on that. So all of these small little martingale trades, they don't really affect my value at risk too much. Again, just a recap, super stable value at risk, 1.92% right now, because I'm running different strategies all at low risk, and I am running grid strategies on this to try and hedge it out, hedge out the exposure. I've managed to keep it super stable. I'm not going to go over that again. If you're interested in hearing what I'm doing to try and hedge my value at risk, I would rewatch this session from the start. Once we've finished, go onto YouTube or go onto X, and there'll be a full recording of it. But I basically spoke about running multiple strategies. This account is kind of a test to see if I can get away with grid trading by hedging it with a few breakout strategies as well. But I'm being meticulous with the position sizing of the breakout trades to try and keep my value at risk super stable. But it's an interesting concept, interesting idea. It's working well so far, so I just need to keep that up. We then have correlation. This measures your correlation between other Darwins just to make sure that, you know, traders aren't copy trading and we're not overexposing ourselves as a business by allocating capital to the two different traders trading the exact same strategy. If you're not aware, you can take a look at your Darwinex Zero Darwin on DarwinX.com also. So you just go Darwinex.com. You would have to log in. So if you haven't got an account with Darwinex.com, you can use your Darwinex Zero login, and you should be able to log in. And then if you go into your URL and put /Darwin/your Darwin or your 4-ticker Darwin, and then a hashtag, you'll be able to search for your D0 Darwin. You can see here, we're on my BYXB Darwin, and you can see it says by zero. So the reason I like coming on here is because we have a load of different statistics that we don't show on zero. Okay, so if you look at this corner, we have all these investable attributes. Now these measure certain things similar to what we've been looking at so far, and there are some that are the same, but we'll go through the ones that aren't on zero just so that you can understand what's on here. But I definitely recommend checking it out. Sometimes said in LA chart, I'm presuming loss aversion chart, is it showing the real win-loss of Darwin by pips? You mean this chart, right? Sorry, dude, my signal is awful. This chart, it's shown by percentage, not by pips. I'm presuming that's what you mean. So jumping back onto Darwinex.com, if we take a look at the first one, it's experience. Now, the only thing that you can do for this is keep trading, right? We measure your experience based on something called D periods. I'm not going to go into the complexities of that, but it's basically just a way for us to measure your trading activity based on time and based on average amount of trades. It's not something that you'll be able to get a 10 out of 10 score in your first month. It is going to take 6 to 12 months to even start getting a good score on experience. It's a way for us to be able to say to an investor, yes, this trader trades the way that they do now and has been for the past 5 years, right? We can then say with confidence, you know, when you invest into this trader, it's likely you're going to see the same behavior. If somebody's joined the platform, like my account, less than a month old, we don't know what this is going to look like in a year. We don't know how stable the trader is. We don't know how the trader, the loss aversion chart is the same as the one that I shown just. So we'll get onto that in a moment, dude. Okay, I'm just gonna stop for a moment because I got a question from Jay Singh again on YouTube. So thank you for sending in your questions. I'm a trader, but right now I'm profitable in stocks, but practicing on prop firms. Do you even teach like some sort of mentorship? I'm presuming you're asking for Darwinex, but no, we don't have a mentorship. We don't teach traders. Darwin is very slow when it comes to funding, and my question is how to find a winning strategy. Okay, so let me address that in two different ways. One, how to find a winning strategy. You got to create it, right? The 90% of what you see online is just fugazi. You've got to create your own thing. Number two, Darwin is very slow when it comes to funding. I disagree. I actually think probably one of the fastest and most sustainable. The only difference is you won't be getting paid 80% of the profits. That's really the only difference. On my XAQP strategy, you see, I got 70K. This has only been around for 4 months. I got 30K on my first month, 40K on my second month. So I would disagree that it's slow. The problem is that we're telling you to build a track record over months and years, but that's where you have to see the long game. So like, I don't really have anything to say about timing or speed because trading isn't something that you should rush. It's not something that you should aspire to rush. If you're looking for a get rich quick scheme, then none of them exist really, or at least none of them exist that are sustainable. And just watch you don't burn yourself out on props because you can get caught in this hamster wheel of chasing that quick return and you know keep feeding the beast and not have it pay off. So just be careful of that, and bear in mind we have about 10,000 traders on our books at both Darwinex and Darwinex Zero, and we provide over 1,500 of them, probably closer to 2,000 when we consider DarwinIA Gold. No, let's say 1,500. At the 10,000 we provide funding each month to about 1,500 of those traders. Now when you consider that prop firms, they have like sub 0.5%, sub 0.1% of traders get funded and get to a payout stage. Like, you know, it's just completely different. I'm already in this field for 4 years and I plan to invest my whole life in this. And okay, my question for you, because you've said how to create a winning strategy. What have you been doing? I don't mean this disrespectful, but what have you been doing for the past 4 years, right? Because not that I think like 4 years is nothing, right? You know, it can take people 5, 10, 15 years to actually become profitable. But what you need to do is look at your experience over the past 4 years, go, what's been going well? What's been going wrong? What do I need to do to get to that next level, right? And you're not going to find answers in prop firms. You're not going to find answers in community groups, I don't believe. Yes, there's some great mentors out there, but you need to just knuckle down, get your head in some statistics. A great platform to take a look at for that sort of thing is Edgeful. Try and build a strategy based off of something that you understand. Take into account different variables. Don't just look at a chart and go, well, when I see this pattern, I'm going to do X, Y, Z. Try and scope out the whole market and try and take in information from so many different angles. But unfortunately, you know, most people don't make it in this game. And so you've got to try and do what everybody else is unwilling to do. Okay, that's my only piece of advice. The next metric is market correlation, and this measures your ability as a trader to trade both directions of the market, so long and short. Generally, the only traders who don't have a good score on this is traders who invest. Okay, so it's like stock and ETF traders, because they're long only usually. And so I don't really read too much into this metric. I think if you're an intraday trader and you trade both sides of the market and you have a poor market correlation score, there's something to investigate there, because it either means that you're too tied to biases, or you just generally get your bias wrong. Because if you've got a poor score, it basically means that you trade long well and you trade short poor, or the other way around. Risk stability is the value at risk chart. We've already taken a look at this, but you can see it's the same. Risk adjustment. So I've currently got a 10 out of 10 on this, which is interesting to me because grid systems usually get fiddled with. So I've avoided that thus far. So I think what I'm doing is working in terms of hedging with a breakout strategy. But this shows how often the risk engine has intervened in your trades. So if it's ever closed exposure on your positions. So there has been times where it's closed certain bits of exposure on my trades, which is absolutely fine. I don't mind it doing that. Because I know that it's mitigating some downside for me on the grid side of things. But it's interesting to note that I'm still scored 10 out of 10. So it still considers me kind of low risk from having to adjust my trades perspective, which is a really, really positive sign. We then have open and close strategies. These are shown on the same page. So close strategy, I have a really high score. Open strategy, I have a low score. That's kind of understandable when it comes to grid systems, because you tend to get pretty poor entries and then it will grid back in and grid back in and grid back in. So your opens of your trades are usually pretty poor. What this does is it measures you against different times. So if you got into the market 10 to 50% before you did or after you did based on your average trade duration, it will show you which would be the better strategy. I would recommend, if you're interested in that metric, doing some reading on it on our knowledge base. I'm not the best at explaining it. I understand it in my head, but it's such a difficult one because it's a custom metric that Javi built, the brain behind Darwinex. It's very difficult to put his kind of mind into words, if that makes sense. And then we have close strategy, and we do exactly the same. We measure basically, are you getting out of the market too soon, or are you holding on to winners too long? You can see I'm actually top of the options, which is surprising to me. But I don't know why that is. Again, is it going to stay that way? We've only got a month's worth of data. Who knows? The one I'm more concerned about is the opening strategy. But again, there's not really a fat lot I can do. I'm trading breakouts and I'm trading grid strategies on this specific account. So the majority of time, they're not good. They're not good entries, but it is what it is. Positive, negative, and duration consistency. We've already looked at that on Darwinex 0. It's the duration versus profit chart. Loss aversion chart is the same as the maximum adverse excursion chart. So we're just measuring your percentage gain and losses. Here's an interesting one, actually. And Snowy, again, this might interest you. So when we're looking at the index, for example, and we're categorizing traders, when we're looking for martingalers and grid traders, what they tend to have is a low open score and a low loss aversion score. Basically meaning that they have like much larger losses than they do winning trades, as does any martingale or grid strategy. But also the opening score is low because it's poor openings, as I've just explained. I actually have quite a high loss aversion score, which is, I think, where I'm avoiding the pitfalls that the majority of grid and martingale traders run into by hedging it with a breakout strategy. You don't have to hedge it with a breakout strategy. You can do it with whatever you want. But I think because I'm doing that and I'm getting these large winners as well, it's negating my loss aversion score, which is putting my account outside of the scope of what would happen to a martingale trader. Now, Snowy, I know you'll understand what I'm on about here when I talk about how the risk engine treats martingalers or grid traders. I think that one thing that I've implemented, which is having a breakout strategy or a couple of breakout systems in there, it kind of doesn't trick the risk engine, but this doesn't look at face value like a grid trading strategy, which is really, really interesting. Like I say, it was a hypothesis that I kind of had, and I thought I'm going to put that to practice. So I put this whole portfolio together, and it's been really interesting to see it coming along. And I thought it was going to be like I'd run it for a month, the Darwin would get created, and then I'd probably cancel the account and just get rid of it. But actually, it's pretty impressive thus far. So I'm going to run it for a good period of time, and see how things play out. I mean, I don't know if my FX book for it's up to date. BYX. Let's take a look if this is updated, just so that you get an understanding for how low risk I'm running it at signal account level. Okay, so it updated an hour ago. So this has updated now. We're at 8% on both gain and absolute gain. So we did go up and then we've dropped back down a bit, but we're higher than we are now. Okay, so we're at 0.8% return. Drawdown is 0.56. So again, like I say, I'm running it at super, super low risk. Profit factor 1.56, pretty much the same as what my Darwin is. I haven't got enough data for Sharpe ratio yet. You can see I'm in a hell of a load of trades. And so yeah, it all looks good right now, but we just gotta see how it goes over the next few months. Moving on to the last two metrics, we then have a performance chart, which is basically a Monte Carlo test that analyzes your strategy, compares it to 10,000 random strategies, all running with the same risk. So at the moment, I'm on the 80th percentile, which is okay. I'd like it to be slightly higher, but because last month was clocked as a negative month, I think that's probably holding me back. It's also holding me back for allocation this month, which is annoying, but is what it is. What this chart is great for is if you start making changes, if you start implementing new things, you can monitor this for kind of real-time feedback. If you implement something, whether you cut out an asset or you add an asset in or add a new strategy, whatever it may be, and then you see a sudden change on the Monte Carlo, you're going to get instant feedback as to whether the changes that you've made was the right decision or not. So there's not too much to take away from this in terms of, it'll give you something to work on, but it kind of validates the ideas that you put into practice. That's why I like this chart, and that's why I don't use it every day, but I review it on, I review it every so often. We've got a couple of more questions from Jay Singh. I was majorly active in stock market. I have proper plan and I'm very good in option buying, but because of indiscipline, I lost huge one day, but I'm getting success in swing trading. Good. I think swing trading is a way forward for a lot of traders, being kind of hands off with things and just letting the market do its thing. It's been a few months into the forex thing, but I have a strategy and I'm seeing some results, but I want to build a long-term profitable strategy like THA. I mean, I love the aspiration. You've just got to knuckle down and do it. THA has been building a record for 10 years, so it's great to aspire to that. And there's no better time to start than right now, right? Do I personally teach? I don't. I have a couple of guys who I work closely with one-to-one, but they're friends. I don't teach people. I don't have a mentorship or anything like that. How did I find my strategy, and how did you know it was a winning strategy? So I trade many different ways. I have my discretionary approach, which I built myself over the years, learned things from different mentors. Credit to Tom Dante. He's the person who I learned most from. But I've had my own adaptations based on data and metrics that I've analyzed and different variables. And then the automated side of things, I knew they were winning strategies because I backtest them and run them through Monte Carlo tests, and I just basically try and break them before I implement them live. And then I run them all as a portfolio to hedge the downside risk of each individual strategy. And then, sir, can I get a job at Darwinex? I would love to work there, even for free. I mean, nobody works for free, but you can take a look on our website, see if we've got any job vacancies. I don't think there's anything as of right now, but I would just keep an eye on our website and or our company page on LinkedIn. We post all job opportunities on there. Just keep an eye out for that. And then hopefully, maybe one day, you'll join me on the team. So the last metric we're going to take a look at before we end the session is capacity. Now, capacity is an interesting one because I always say this to people: it's not an issue until it's an issue. For the most part, anyway, or for most traders. Basically, what capacity does is it analyzes your max investment, or what's otherwise known as your alpha cap. Okay, so how much capital can this trader manage, right? And a lot of people don't actually realize that there's a cap to how much money that they can manage, right? You think I've got a trading strategy, it's profitable, I'll just be able to scale it and scale it and scale it. But actually, that couldn't be farther from the truth. Every strategy has a peak or a cap to which they can't really take on much more capital. And it's not really due to the pattern or the strategy itself, but more to do with the liquidity and the flow of the orders. Now, what we do is we measure your alpha cap by looking at the toxicity flow of your orders. We then measure the divergence that an investor would have if they were copying or mirroring all your trades with a certain amount of volume. And then when we can say that an investor is going to be getting slipped X amount of pips, that's when we would say that's your alpha cap and your strategy would be cut off. So we measure the divergence. So you can see up here, this is the divergence chart. So if an investor was getting slipped 2 pips on every trade, my Darwin as of Monday this week was up 2.68% in profit, but an investor would be down 0.55% if they were getting slipped 2 pips. So whilst it doesn't seem like a lot, that is a big difference. I've made almost 3% this month, but an investor, or since inception, but an investor would be down 0.5% just by being slipped 2 pips or by getting worse fills than me by 2 pips. Now, if somebody's following you with 10 million or $100 million and you're trying to fill that market and you're trading exotic pairs or you train through the Asian session, these are all things that makes it really difficult to get that capital filled or to get those orders filled. And so it's really important that you're trying everything that you can to trade in the most liquid times of day and the most liquid sessions, trade the most liquid assets like euro dollar instead of, euro sec or something like that. Hold trades for a little bit longer, have a bit of wider stop losses, all kind of common sense things that would help you manage more capital, right? But once we've measured your divergence sensitivity, we then take a look at actually how much capital you would manage before you start to see this discrepancy in the return. So if we scroll down here, you can see capacity max estimated investment for the Darwin. You always get this bump after calibration phase. I don't know why, happens, just ignore that initial bump. But you can see right now, this is my grid strategy again with the breakout hedge. You can see right now my alpha cap is around 70 million US dollars. So theoretically, at this point, the way this strategy trades, it could manage up to 70 million before we run into an issue with alpha cap. And I put that down to I'm running it on multiple assets. I'm running really, really low risk. And so it's very easy to scale it. And I'm holding the trades for a long period of time, usually. Okay, it's not a scalping, it's not just getting in and out. Sometimes it does, but for the most part, I'm sat in trades for quite some time. So I do have a relatively high max investment, but the reason I say this isn't a problem until it's a problem is because sometimes traders don't realize how bad their trading strategy is from a capacity perspective. And they might put a load of time and effort in for a few years building a strategy, only to find out that they can manage 200K. And whilst 200K might be life-changing for somebody, it's not a career amount of capital to manage, right? Especially if it's from an investor. If it's your own personal funds, then you can probably make it work. But if it's 200K of an investor capital and you're keeping 15% of the profits, it's probably not enough to make a career and to, be this huge trader. And then you run into the issue of, well, I've got to change my strategy now because it's not capable of handling an investor of size, right? But usually by that point, it's too late, okay? And the trader spent so many years perfecting something that they now have to go and change everything about it. And so it's an important one to know where you stand. In fact, I'm going to check while we're here, before I finish, I'm going to check XAQP, which is my main portfolio, because I think it's much lower. I think it's much lower capacity than that one. Yeah, so it's 14.5 million. Interesting. Okay. 14.4 million on XAQP, which is a shame, but is what it is. Scalping has low capacity but high performance. Yeah, 100%. Scalping is really difficult to scale up to size. Like I say, getting in and out of the market quickly just basically means more quicker fills. It's more important for the investors to get filled at the price that you're trying to execute at. And sometimes it can, it can be really tough to do. Anyway, guys, that brings us to the end of the session. So I hope you found some value in the things that we went over today. It was a bit of a different one because I was analyzing my own strategy and talking you guys through it. But I hope I've given you some insights into how to try and get a grid system to work. Like I say, whether it works long term, I don't know, but as of right now, it's looking to. And I'm really impressed with the performance that it's had thus far. It's just got to maintain it now for, you know, an extended period of time. We will be back tomorrow at 4 p.m. UK time to do a Darwin explanation session, which is where we go over risk and exposure and all of the kind of more complex nuances about trading with Darwinex Zero. So if you want to learn more about that, make sure you're back here tomorrow for 4 p.m. UK time. And if I don't see you till then, have a fantastic rest of your week, and I'll catch you in the next session. Bye, guys.